Sorry, Mr. Mitrano, we just...
It's my fault. It's my fault. Okay.
Thank you for your patience.
Ready to go. Ready to go.
Ready to go?
Yes.
Okay, thank you. Good morning, good afternoon, good evening from HESEC, Harvard Extension Student Environmental Club. My name is Yashi Dadich. I'm the Director of Marketing at HESEC. Our club represents a student club with a mission to raise sustainability awareness among Harvard and communities worldwide. We actively foster collaboration, networking, and development opportunities for all our members. Thank you all for joining us today for our webinar with Mr. Amitrano. He's joining us from Italy. Mr. Amitrano is the Executive Director of the Digital Gold Institute. He teaches Bitcoin and blockchain technology at Politecnico di Milano and Milano Bicocca University. He was the former head of blockchain and virtual currencies in Intesa Sanpaolo Bank. He has been invited to events about Bitcoin at United Nations, central banks, the Italian Parliament, universities, conferences, and workshops. He's the fintech innovator, technologist, and open source developer. He's the author of multiple scientific publications and contributor to multiple media outlets. Mr. Amitrano will be talking to all of us about the role of Bitcoin and blockchain technology in economics and environmental sustainability today. We'll open up for questions from all our viewers towards the end of the webinar. This webinar will be recorded and posted on our website within the next 48 hours. At this point, I request all our viewers to please mute their microphones. Thank you. Mr. Amitrano, we welcome you to today's webinar. Thank you very much for your time and support. We truly appreciate it.
Thank you to you for inviting me. And okay, let's start straight ahead. Okay, so economics and environmental sustainability of the digital scarcity experiment. So even in the title, I'm already pointing out what, in my opinion, is Bitcoin and blockchain technology is all about digital scarcity or scarcity in the digital realm. And well, when we talk about Bitcoin, there are a lot of understanding that goes on. And this is because in a way, Bitcoin is hard to understand. It is at the crossroad of cryptography, computer networking and distributed systems, game theory, monetary theory. So it's pretty much difficult to find anyone to be skilled enough or competent in those four areas. Moreover, Bitcoin is a subject with relevant cultural and political implication. So people often stand on one party or another party based on their ideological beliefs. But what's for sure is that Bitcoin and blockchain are not just a technology or not even a technology, but a cultural paradigm shift instead, in my opinion. So for today, we will have quite a rich agenda, but let's go through it. We live in the information economy, and we have seen the mail becoming electronic, the Britannica Encyclopedia disappear from our shelves because of Wikipedia, music and films are liquid. There is a huge expectation that all financial and banking system might shrink down and enter into our smartphone. And the Bitcoin blockchain is, in my opinion, in pole position. Why that? Well, first off, today data is transferred with zero marginal cost. And nonetheless, we pay a fee to move the few bytes representing our own wealth. I mean, we can move few bytes representing our own wealth from 9 to 5, Monday to Friday with 2 or 3 days settlement. And if we are talking about transfers of value, which are cross-currency or cross-border, the situation is even worse than that, much worse than that. And so the question is not if, but who and when will gift humanity with a global, instantaneous, free, peer-to-peer payment network. This was already expected by Milton Friedman, the Nobel Prize laureate, in 1999. The one thing that's missing, but will soon be developed, is a reliable e-cash, a method whereby on the internet you can transfer funds from A to B. And please note that without A knowing B or B knowing A, the way we can take a $20 bill and hand it over to you. And so he was talking about electronic cash, not electronic money. Bitcoin, probably all of us have a decent understanding of what it is, a decentralized digital currency, where the crucial part is not about being digital, our dollars and euro are digital mostly, but about being decentralized. Decentralized means that it's not backed by any government or organization. It has no need for a trusted third party, and nonetheless, it allows instantaneous peer-to-peer transactions based on cryptographic security and also on synergic economic incentive. This will be one of the major takeaways of our webinar, hopefully. And so it represents, or it might represent, efficient low-cost banking for everybody everywhere. I mean, we're not talking about, you know, some toy stuff. This is a transaction in December 2014 where 83 million US dollar, I mean, 200,000 plus Bitcoin at the time worth 83 million US dollar were transferred instantly, securely, in a non-censorable way for just 4 cents of fee. And this is what basically is scaring the banking and financial system today. Bitcoin is really in pole position for becoming the internet money because it is decentralized, as we said. It is permissionless. It doesn't ask regulator for permission. It is censorship resistant, open access, free, borderless, transnational, cross-jurisdictional, secure, and even very much resilient. But before talking more about Bitcoin, it might be worth spending a few words about money. I mean, what is money? It might surprise few of us, but it took me about 44 years before stopping for a second and asking myself what money is. I mean, I have a physics background, but I worked for 20 years in interest rate derivatives. Nonetheless, I never stopped for a second asking myself what I consider money to be or what money is. When I encountered Bitcoin in 2014, that was the most provocative question I had. And I turned out with the answer, money is a social relation instrument. I was very proud at the time of this answer, just to discover, as often happened to me, that somebody more brilliant than me discovered that or say that a few centuries before me, in that case, Adam Smith, I would say. But what we mean by social relation instrument? As human beings, we are all born into a gift economy. I hope that nobody listening to this webinar had to pay for the parental care received at home. And this kind of gift economy usually includes our family, an enlarged family, our neighbors, let me say, even our whole tribe. But it does not scale up. As soon as we encounter somebody we do not know, and because of that we do not trust them, or sometimes we do not trust them because we know them, but that's basically the same, I will say. I mean, as soon as we enlarge our relationship circle, we need an exchange economy. Yes, we are such social animals that we want to cooperate and trade even with people we do not trust, even with people we do not know. And so the first instance of an exchange economy has been the barter economy. But the barter economy is severely limited by the coincidence of wants. I mean, I might want to buy your eggs today, but you might need my milk today. And so we have a coincidence of wants in time and space. in order to disintermediate this limitation of the barter economy, human beings have invented money as medium of exchange. And I really hope that you stop for a second and do really appreciate how powerful this idea is. Because the fact that money is the synthetic instrument that as human beings we have invented to cooperate with people we do not trust, with people that we do not know, it's pretty powerful idea, if you ask me. And since we are, for the first time in history, in a truly global information economy, a supranational digital money is what we need. So let me say, allow me just for the sake of fun, in a way, to describe the whole monetary history in just one slide, okay? So the first commodity monetary standard has been gold. Why gold? Well, because it is scarce, because it has a pleasant color, that is, it is resistant basically to corrosion and oxidation. It's highly malleable, and so it's relatively easy to assess gold purity. Nonetheless, if you are a merchant, and before any economic transaction, you have to fire up some fire and melt down the gold and wait for it to cool down to check if it is still shining, in which case it is blue. Well, that is pretty much cumbersome, if you ask me. And so we ask Julius Caesar, or in general, any power, any government, to certify for us gold purity. The first inflation crisis in history is already under Caesar Augustus, you know, just the one emperor after Julius Caesar. Because even the poor people on the street, they were able to figure out that the sestertius didn't hold the amount of gold that it claimed to have. But if you are a merchant, there is another problem. Gold weighs a lot. I mean, its density is really, really impressive. And moreover, I mean, if you take gold with you, you are at risk, because at risk of robbery. And so the goldsmith of London and what will become the central bankers in Italy, or sorry, the bankers in Italy, at the same time, they had the same idea. They approached the merchants and told them, why don't you leave your gold at our premises, in our vaults? We issue some kind of note to you, and those notes in time, they became, you know, transferable, and those notes could be redeemed at their premises for gold. It was the birth of representative money, what we call today the banknote. Both the goldsmith of London and the bankers in Italy, they noticed that the amount of people, the number of people turning back to them for redeeming money, banknotes for gold, was very, very low. Some historians even say something like 15–20% of the gold reserves. And so they had the same idea. What if we issue more notes than the gold we have in our vaults? And you know what is the answer? Basically nothing happens, because nobody noticed. And so that was the birth of fractional receipt money. Let's fast forward to 1972. No currency was convertible in gold anymore, but because of Bretton Woods, they were all convertible in US dollar. And the US dollar was the single only remaining currency convertible in gold. But Richard Nixon shock, say, enough of that. This kind of convertibility is too strict of a constraint for our monetary policy. Since then, we have fiat money, as in fiat lux et lux fuit, you know, money that has value just because we decided to have value. And if somebody disagrees with us, we force that value upon him by legal tender. As you can see on the screen, what has happened since 1971 is that the gross public debt has been skyrocketing, and not just in the US, but worldwide, because of that broken up convertibility. And so, if you allow me, I would love to quote Friedrich Hayek, the Nobel Economic Laureate, the founder of the Austrian School of Economics, where he say, I don't believe we shall ever have a good money again before we take the thing out of the hands of government. That is, since we can take them violently out of the hands of government, all we can do is by some sly roundabout way introduce something that they can stop. And this is exactly what Bitcoin is. I mean, to figure out that government has been providing us with bad money, you have not to look at the dollar of Zimbabwe and its horror inflation, but even the gold US dollar. I mean, in the first century, since the establishment of Federal Reserve in 1913, has lost 96% of its purchasing power. And if you keep counting to these days, you will see it has lost 98.5% of its purchasing power. And so, again, with von Hayek, I will suggest everybody to read Denationalisation of Money, a pamphlet by Hayek that he has spent his last 20 years of life and study continuously writing and rewriting it. In the Nationalization of Money, Hayek, of course, complains about the history of money being largely a history of inflation engineered by governments for their own gain. But even more, he's upset as to why we consider the government monopoly of money as indispensable. As every monopoly, it has deprived public of the opportunity to discover and use better reliable money. And so he wished that blessed will be the day when it will no longer be from the benevolence of the government that we expect good money, but from the regard of the banks for their own interest. Well, unfortunately, I mean, he was dreaming about money issuing about retail banks issuing private money, but that was not being the case. Private money has been advocated in the last 10 years by permissionless innovation. What do I mean permissionless innovation? No centralized security mechanism, no barrier to enter, no editorial control. If this sounds too radical to you, please don't. Because this kind of permissionless innovation is basically gentle, fast, and effective. You already met this kind of permissionless innovation. I mean, email has not been designed by a consortium of postal agencies. Internet has not been developed by a consortium of telcos. It escapes me why someone thinks that a new money and its decentralized transactional network could be designed by a consortium of banks. So private money, they have to be a widely accepted medium of exchange. Please note, widely accepted, not universally accepted, issued by no governmental body and without legal privileges. There are many reasons for demanding private currency. Some of them are good, some of them are not. But in the end, it's just the need or the desire of requiring better money. And this movement in history crosses path with the Cypherpunk movement. Please note Cypherpunk, not cyberpunk, okay? The Cypherpunk is the movement which looks at cryptography as the way to defend our privacy. It has been pretty much effective in the last few years, I would say, because basically all communication means these days are fully encrypted end-to-end. Cryptography is in a way the slingshot that David the little man can use to kill Goliath, the dystopian big brother. And the Cypherpunk Manifesto in the Cypherpunk Manifesto, Eric Oakes was also hoping that cryptography could not just be used for our privacy in communication, but also for our privacy in financial transactions, we say with electronic money. And as a matter of fact, there has been many Bitcoin precursors attempting or trying to reach some kind of digital private money. The major example of private money are probably Liberty Dollar and eGold. In both cases, the founder and administrators have been arrested. Why that? Well, not because of crimes committed by themselves directly, but because it seems those platforms were used by criminals. The point about the failure of those two experiments was the so-called centralization dilemma. Because, of course, as long as you have a central server or a central admin managing any kind of electronic money, this is easy to shut down. And so people have been looking at decentralized technology like BitTorrent for sharing files, because that seemed promising. But I mean, BitTorrent for sharing files is completely different from digital money. When you want to share a file, you want to make multiple copies of that file available. Instead, in any digital cash scheme where you have a single digital token that you want to have some economic value, being a digital file, it can be duplicated. And since it can be duplicated, it can be spent twice. If you think about the digital token, nothing is really preventing Alice to send that token to Bob, but then sending a copy of that token also to Carol. So basically, double spending a digital token. This double spending problem has been really crucial because, I mean, to securely transfer value using digital means is nothing new. It has been possible for decades if you think about SWIFT transfer. But in a digital cash scheme, a single digital token being just a file that can be duplicated, can be spent twice. And so we worry about how to prevent Alice from spending the same coin or Bitcoin on digital token twice. If you think about a digital artifact representing value, like, you know, the amount of money you have on your bank account, there is a central authority, your own bank, managing its own ledger and forbidding you to transfer your amount of money twice. If you think about Mona Lisa, I mean, Mona Lisa is beautiful. Mona Lisa price, market price cannot be really estimated. But if Mona Lisa could be duplicated in an unlimited number of copies, of perfect copies, it will remain really beautiful, but the market value of Mona Lisa will drop to zero. So for a digital artifact to gain value, you have to prevent double spending. And so far, before Bitcoin, the only way we could prevent double spending was to rely on a centralized trusted party, which was in charge of managing some kind of ledger. Well, it comes October 2008, where an anonymous, unknown Satoshi Nakamoto, he claimed that without help of a trusted third party, he was able to prevent double spending. The coins were made from proof of work, we'll see what that means, and proof of work prevent double spending. How did he achieve that? Well, if you look at the Bitcoin network, you can consider the Bitcoin network as a distributed back office. All network nodes validate and clear all transactions, but some special nodes, those called mining nodes, they provide the additional computational power required for transaction settlement and finalization. Without a central trusted party, how do they reach distributed consensus on the transaction history? Because consensus in a distributed asynchronous network with even just one faulty or malicious node is an impossible problem. I mean, it's a positive result of computer science that distributed consensus in a synchronous network is impossible. This is not hard to understand. I mean, right now we are not in a synchronous network because I'm talking and all of you listen at the same time. But if you were able just to talk to each other on a one-by-one basis, and let's say that we want to reach distributed consensus on a logical variable, you know, true or false. And I say to Stefania, true. And Stefania might be a faulty node. Maybe she's deaf impaired. Sorry, Stefania, for picking you out. Or maybe she's malicious. You know, she loves to jeopardize stuff and she propagates false. We can spend how much time we want on this one-to-one network. There is no way for all of us to reach distributed consensus. Not even on something as simple as a Boolean logical variable as true, false. So how can we reach consensus on a ledger preserving economic value, where you can take it for granted that you will have a multitude of nodes trying to manipulate communication in order to gain some unfair economic advantage? Well, let's focus on how Bitcoin works before answering that question. And Bitcoin transactions are bundled in blocks. They are not settled, they are not finalized one by one, but about one block of transaction every 10 minutes. These blocks are sequentially chained.
You know what I was thinking? We have been sharing so much. I don't know if anyone has any question or anything that wants to ask. You can write in the chat, okay?
Okay, and let's reserve the question for the end of the presentation.
Yeah, no, definitely. I was saying if you guys want to already start writing your question in the chat, it would be a really good idea. Okay, sorry.
Looking forward to all your questions. So these blocks of transactions, they are sequentially chained, and the cryptographic link between blocks requires computing power to be created. A block, of course, is only valid if it includes valid transaction. And so mining, the miners, the mining nodes, they kind of compete to finalize, to settle a new block of transaction, because the winner providing proof of work for the finalization of new block is rewarded with the issuance of new Bitcoins in a special coin-based transaction, which, please note, it is included in that same block. So miners solve the double spending problem, because if they were to include an invalid transaction, such as a double spending transaction, as soon as they propagate the block to the rest of the network, and provided that the majority of the network is composed by honest nodes, well, those nodes will just trash that block as invalid and will reject that block. But in that case, even the Bitcoin reward, the issuance of new Bitcoin that is rewarding the miner for the block finalization, will be removed from the transaction history because it will be trashed away along with the block it is contained in. And so the winning miner would have wasted his work. So if I've been clear enough, it's evident that there is an economic incentive for the mining nodes to be honest. And because of this proof of work, the chances of a block being altered, they decrease exponentially with the number of blockchain after it. And so the blockchain is a history of transactions resilient to network attackers because of this computing power that kind of secure the network. The miners have to provide computing power. They better be honest, otherwise their work will be wasted. But if we accept their work, this kind of computing power kind of adds up, granting the ledger immutability. I mean, the blockchain is immutable only because whoever wants to change that should provide more work than the amount of work being accumulated by honest nodes. And so Nakamoto solves the problem of distributed consensus, reaching what is called practical Byzantine fault-tolerant distributed consensus, which is achieved, please note, by some game theoretical economic incentive for the mining nodes to be honest. Double spending is solved without a central trust party, Bitcoin can resist the attack of malicious agents, and miners are compensated for their proof of work using Seigniorage revenues, that is the issuance of new Bitcoin. So Seigniorage revenues, the huge amount of wealth that originates from the ability of printing out money, is kind of subsidized to cover for the network cost, or even better, to cover for the distributed consensus cost. We're talking about order of magnitude 7 billion per year. 7 billions per year. And this amount of money has actually triggered a competition where the hash rate, that is the measure of the computational power of the Bitcoin network, has been skyrocketing to hundreds of times being more powerful than the combined world top 500 supercomputers. And of course, the top 500 supercomputers are much more flexible than the hardware used in the Bitcoin network. But when it comes to the hash calculation, that is the basic calculation that is required by the Bitcoin network, the Bitcoin network as a whole is much more powerful. This is the most secure network we have ever seen. No financial or military network have comparable security. And to manipulate the Bitcoin history, you require 51% of this hash rate, something which is not easy to achieve, especially because the hardware you need to achieve such a powerful computational level are specialized hardware. Gone are the days of using CPUs or GPUs or FPGAs. These days you need application-specific integrated circuit designed and manufactured for the specific purpose of the Bitcoin computation. And so the mining reward, the Seigniorage revenues included in the block for the miner providing the proof of work of finalizing a block of transaction, has triggered this growth of hash power, or computational power, which in turn has made Bitcoin network even more and more secure. But the more secure network has increased the Bitcoin price, the Bitcoin value of the market. And all things being equal, the amount of Bitcoin being provided as Seigniorage revenue to the miners, an increasing and appreciating Bitcoin price has made this mining reward much more richer in terms of purchasing power, and so on and so forth in this virtuous cycle that has not stopped. It's 10 years now. This proof of work, in a way, resources, computational resources, energy, is consumed as proof of work in order to make Bitcoin valuable, and miners are willing to destroy resources to acquire Bitcoin. In a way, they are the first on the market to recognize Bitcoin value and to spend resources in order to acquire it. Of course, miners are rational economic agents, so they locate their business where energy is cheap, typically where you have abundance of renewable energy. And the energy consumption of the Bitcoin network has not been growing linearly because of this efficiency improvement, like GPU into GPUs, into FPGAs, into ASICs. The Bitcoin energy consumption is about 8 terawatt per hour. Okay, this is an impressive number because it's comparable to Ireland or Denmark consumption. But this is just 1/8 of the US data center and 21 basis points of the US overall consumption. So we have to put that in a context. Moreover, the banknote system is estimated to have an energy consumption of 11 terawatt per hour. Gold extraction, 132 terawatt per hour. And to top this, 26 China hydroelectric untapped capacity, which has been dissipated because there was no use for that, amounted in 2016 to 95 terawatt per hour. So I think that is not completely unreasonable to expect that in the future, proof of work might kind of absorb all renewable energy excess capacity available. Bitcoin as digital gold. Well, this growth of proof of work, this growth, sorry, of computational power might lead us to expect that blocks have been finalizing faster and faster. But this is not the case because the proof of work difficulty adapts about every 2 weeks to the overall available computing power so that we have one block every 10 minutes. This is crucial because this defines Bitcoin monetary rules, actually the only Bitcoin monetary rule, which consisted in 50 Bitcoin per block every 10 minutes. This amount has been halving every 4 years, so we are already in the 12.5 Bitcoin per block era. This is the only way new Bitcoin are released, and this is called mining because of its similarity with the progressive scarcity of gold extraction. So Bitcoin supply is free from discretionary intervention, and this is the Bitcoin fixed monetary policy. It's a deterministic decreasing rate of issuance, but most of all, it's completely inelastic supply. So what makes Bitcoin special? Well, not the fact that it's digital and scriptural because our US dollar or euro are the same. Maybe the fact that it's an asset, not a liability. I mean, because Bitcoin is not a promise, it's not an IOU. Bitcoin is a bare instrument. We have not been talking about technicalities here, but if you lose the private keys that control your Bitcoins are gone. Bitcoin can be transferred but not duplicated. It can be spent or not double spent. And let me stop on this point for a second. Please do appreciate how powerful this is. Because I don't know, but probably I will bet that most of you, before this webinar, you have been assuming that anything digital could be duplicated. So this is the first time you might be realizing that there is something digital that can be transferred but not duplicated. Moreover, Bitcoin is scarce in digital realm as nothing else before. You have seen that it will reach 21 million in 120 years. It mimics, so the gold monetary policy of decreasing incremental extraction because the amount of Bitcoin being issued is gradually decreasing in time. So what makes Bitcoin special? Bitcoin is, or at least wants to be, digital gold, the digital equivalent of gold. And it is a kind of digital gold with a secure and sensible embedded settlement network. Bitcoin is more a crypto commodity than a cryptocurrency. And this is the groundbreaking achievement by Satoshi Nakamoto, not the so-called blockchain technology a lot of people talk about. Bitcoin relevance. Well, if you think about the role of physical gold in industrialization, money, and finance, you might appreciate that the digital equivalent of gold could be really disruptive in the current digital civilization and the future of money and finance. Bitcoin can really be the new global reserve asset. And if you ask me, it is disconcerting that people are still continuously underestimating Bitcoin. Okay, I know that you're skeptic, but let's for a moment assume that an alien arrives and joins our webinar. You have to defend the fiat money, traditional money, and I defend Bitcoin, okay? I kind of attack you because I say that your money has no intrinsic value, but you counteract and you say, okay, it has legal tender, there is a social contract, and you say, even Bitcoin has no intrinsic value, but I say, okay, it's digital equivalent of gold. Okay, we're even, let's start over. Then I make the point to the alien that your currency security is based on paper and ink, while mine is based on math and cryptography. that you have discretionary governance of your monetary policy. That is, there is a central banker which can print how much money he wants to give it to whoever he wants, wherever he wants. He has not been elected, and is unaccountable of his mandate. Instead, Bitcoin has algorithmic governance. I will skip details about interest rate comments, but let me make one final point for our alien, that your US dollar and euros, they are coerced upon everybody with legal tender. Instead, my Bitcoin is available as free, non-binding choice. I will leave it as an exercise to you to figure out what might be the opinion of the alien. I know on Bitcoin there are different opinions. Greenspan says that it's a bubble, but if you look at the former CEO of Goldman Sachs, he says something much more interesting. He said that maybe Bitcoin is a natural progression from hard money, that is money backed by gold, to fiat money, money not backed by gold, to, he says, consensus money. And I mean, the fact that he used the word consensus is pretty much impressive, because it's consensus as in, you know, the lay meaning of that word. We just agree on what money is. But this is consensus also in the distributed consensus sense I've been trying to explain before. Yes, because if you look at Bitcoin using game theory, it might be helpful to look at Schelling point. Schelling point is the focal point for each person's expectation of what the other expects him to expect to be expected to do. Sounds convoluted, it is, but it's pretty easy to understand. Let's figure out that two people are unable to communicate, but are urged to select a square among a series of similar squares, and they will be rewarded only if they select the same one. Let's assume that these are the squares. Which kind of square do you think that everybody will select, even without central coordination? Well, of course, the red one, the more natural, special, or relevant. So if we look at money, and we have to select what is the consensus money, I dare to say that Bitcoin is the consensus money. Bitcoin is the Schelling point of consensus money. Everybody these days studying money or monetary system will agree that Bitcoin is a pretty much powerful experiment. Okay, there are people complaining that Bitcoin transactions are not taking off. Well, that's fine, especially considering that there are people who have paid 10,000 Bitcoins, so $50 million at the current exchange rate for 2 pizzas in 2010. So if you ask me, you're much better off not spending those Bitcoins. Bitcoins are to be used as reserve currency. The ultimate fate of Bitcoin, as it was already understood by Old Finney, the first cryptographer to pay attention to Bitcoin, is to serve as a reserve currency. And so the real comparison is between Bitcoin and gold, not between Bitcoin and money. And I will read on the left, you read on the right. Gold has been adopted without central planning. For centuries has been the most successful form of money. It has bootstrapped all monetary system we know of. It has been surpassed by other kind of money without becoming obsolete. This is exactly what is happening to Bitcoin right now. Yes, even about new generation of money, new because there are people, myself included, advocating what we call Hayek money. That is a cryptocurrency monetary standard of elastic, not inelastic as Bitcoin, elastic non-discretionary supply that might provide price stability with respect to a reference basket. And Bitcoin could be used as a reserve asset. And so we will have the Hayek dream becoming true. Concurrent cryptocurrencies competing in monetary policy definition and reference basket choices. If you want more details about that, just peruse my bibliography. We might have private monies competing with legal tender money. We might see the separation of money and state, as in the past we have seen the separation of church and state. And so let me conclude with some in a couple of minutes on Bitcoin as investment asset. Because let's face it, if we are talking in this webinar, if you are paying attention to this webinar, it's because of this price chart. Or by the way, I should update it, Bitcoin is now $5,000. But this price dynamic, this huge, impressive scaling volatility, well, this should not be really scaring us at all, because volatility is physiologic when it comes to assess the fair value of something controversial as the digital equivalent of gold. If you compare with the history of Amazon, you can see that both Amazon and Bitcoin, they reach their peak, and then they have an incredible, dramatic drawdown. But if you extend the history of Bitcoin as similar to the history of Amazon, you see that the exponential growth is there, or at least might be there, because today the value of digital gold is as hard to grasp as it was in the 90s, the value of e-commerce. And as a matter of fact, the exponential growth of Bitcoin is pretty much impressive. And even if you plot the yearly lows of Bitcoin, you see on the right side of my slide, they've been increasing each and every year, or almost every year. Of course, Bitcoin is a very risky asset. And so such extraordinary returns, they are to be paid with annualized volatility, which is an order of magnitude compared with commodities or currencies or equities or bonds. Oh, well, the Bitcoin volatility is comparable with the VIX, so the volatility index. But the worst offending or scaring number is that worst drawdown, 93%. So peak to valley, Bitcoin has been able to lose 93% of its value. Well, again, VIX has similar performances, but the takeaway is not invest in Bitcoin more than what you can really afford to lose. The good news is that Bitcoin is completely uncorrelated with other asset classes. As such, it provides a huge diversification benefit to any investment portfolio. And if you plot any CAPM efficient frontier, you can even optimize with conditional value at risk, you will see that optimal allocation suggests some Bitcoin, because the efficient frontier improves a lot if you introduce Bitcoin into the allocation portfolio. And even from very conservative risk profiles, from 2% up to 5% of Bitcoin is pretty much invested. I mean, you shouldn't pay attention to CAPM on a quantitative level, but on a qualitative level, this is a pretty much impressive result. Especially because if you assume that 2% of the assets under management worldwide might invest in Bitcoin in the coming years, the price of a single Bitcoin should reach $100,000. If Bitcoin will ever reach the gold capitalization of 8 trillion, and I say if, because Bitcoin is a huge, brave experiment, it might fail, but if it succeeds, it is a lighter gold, a faster to move gold, a cheaper to move gold, a safer to move gold. So it's much better than gold. And 8 trillion capitalization will be $400,000 per Bitcoin. Last but not least, Metcalfe-Law said that the value of a network is proportional to the square of the number of users. It is estimated today that Bitcoin investors are about 50 million, with a forecast to 350 million in the coming years, which is a relevant but not huge number. The Bitcoin price might increase of a factor of 50. Now, you know, $100,000, $400,000, $500,000. I'm not selling Bitcoin to you. I'm just explaining that if Bitcoin is digital gold today, it's hugely undervalued. So there is a bibliography that you can check to go deeper into the issue we have touched upon. But few takeaways before the questions. Bitcoin and blockchain Well, we're not talking about technology, but about a cultural paradigm shift instead. Bitcoin solves the double spending problem of distributed consensus, allowing to move from the centralized paradigm to the decentralization paradigm. Bitcoin's aim to be digital equivalent of gold might prove to be as relevant as gold for the history of civilization, the future of money and finance. It is already bootstrapping new monetary system. Bitcoin has no correlation with other asset classes. Bitcoin investing is rational diversification. And hopefully, I also provided some elements of environmental sustainability and economic sustainability of the Bitcoin experiment. Okay, thank you very much. Time for the questions.
Thank you, Mr. Amitrano. We have a question from Natalia, and she's asking, what do you think about Ether or Ripple or even IMB blockchain? Do you think any cryptocurrency has an advantage?
No, not really. I think that most of the Bitcoin clones are without any real value. Let's try to think on a pure theoretical level. When it comes to digital scarcity, if the first experiment at digital gold will rust, will rotten, what will be the chances of a second attempt to, what kind of guarantees a second attempt might provide? Not to be superseded by a third attempt, so on and so forth. So digital scarcity might have, digital scarcity should go forward without solution of continuity. Evolutionary path, but not replacement. Other cryptocurrencies, they are trying to provide maybe some different stuff. There might be some complementary approach. I'm not convinced at all so far, and especially when we look at the so-called IBM blockchain or any kind of blockchain without Bitcoin, that will be for another webinar. But if you check online my material, you will see that I'm pretty much skeptical. There is no blockchain without a native intrinsic digital asset. Without such an asset, you cannot reach distributed consensus. So blockchain will be just a subpart data structure, which is centralized, and you might be much better off using regular relational databases instead of blockchains.
Thank you, Mr. Amitrano. We have one more question. When discussing the components of Bitcoin, you mentioned the need for trustworthy miners. How does a blockchain ensure that all miners are trustworthy?
Well, what we actually need is for the network, for 51% of the computational power to be honest, not everybody. Then it's not like we have to trust miners, or in a way we have to trust miners' greediness. It's their economic incentive, which are coupled to not validating invalid transaction that we rely upon. So it's not like, wishful thinking or miner to be trustworthy, as much as miner being economic rational agents pursuing their own economic interest.
Thank you, Mr. Amitrano. I have another question. If Bitcoin volatility is uncorrelated to other asset class, what are the main factors of Bitcoin volatility?
Yes. So the key point is that as I tried to point out, the supply of Bitcoin is deterministic. It's fixed, cannot be altered. So wherever the demand of Bitcoin changes, the supply does not adapt. And since price is all matter of matching supply and demand, if the supply is fixed, wherever the demand increase, the price those increase. And wherever the supply decrease, the price has to decrease. And that's it. So it's a genuine, pure, unadulterated market dynamic.
Thank you. I have another question Can Bitcoin be a consensus currency if not available to everyone, since technology is needed?
Well, let's say that relevant computational power is required by special Bitcoin nodes in order to validate, or well, actually to finalize transactions. But for the rest of the nodes, they can be very light node. I mean, the resources needed to be a full node are very, very much limited. I mean, the computer I'm using for this webinar, while we are talking about the webinar, is acting as a full node Bitcoin, okay? And there is no whatever on my CPU. Yes, I have a pretty large SSD hard drive, 200 plus gigabyte dedicated to Bitcoin, but nothing really, really demanding. Last but not least, I mean, you can even use a light client like your smartphone and to use Bitcoin, and that's enough. Of course, if you use a light client, you will be relying on some full node somewhere, but I mean, there are 100,000 full nodes connectable from every, many different parts in the world, and so the network is decentralized enough to be reliable, and the resources to use Bitcoin from the end user point of view are very much limited.
I have one more question. Can you please talk to us a little bit more about energy use of Bitcoin and blockchain?
Yes. I had that slide on the consumption of Bitcoin. I hopefully made it clear that, of course, the energy consumption is relevant, but it's nothing exceptional or scaring if compared to the kind of energy we are used to see in comparable industries, like just, you know, the industry of the banknote system, like the managing banknotes, and is one order of magnitude lower than gold extraction, and one order of magnitude lower than the untapped hydroelectric capacity in China. The key point is that the energy used by Bitcoin miners being economic rational agents, it's of course renewable energy, because they locate their operations wherever energy is cheap, wherever even energy has negative prices. You might know that when it comes to renewable energies, if you have a surplus, there is no way to store it and you have to consume it. And so wherever you have hydroelectric capacity or solar power or wind power, there are moments of the day or moment of the year where energy has a negative price. You are paid in order to consume it. And this kind of energy has a very low CO2 impact, because yes, of course, there is an impact because of the hardware of the server farm and so on and so forth. But in terms of pure energy consumption, the CO2 impact is very, very much limited.
Thank you. We have one more question. What's your opinion about using blockchain for security tokens, STO?
Well, security tokens, they will be nice. I mean, security token is the idea of issuing securities on the blockchain technology so that you disintermediate venture capitalists and banks and regulators. Unfortunately, this has been used so far basically as a fraud. And SEC has been right to point that all STOs so far has been securities, not utility token, as somebody say. And as long as they are security, they should be submitted to regulation. I mean, I'm an advocate of more liberal and libertarian systems, but as a matter of fact, the technology and regulation limitation has made STOs a quick way to raise capital and oftentimes for the entrepreneur to run away with money. That's it. But let's look forward to the future and maybe things could improve, can improve.
Thank you. One of our viewers is requesting that, will you be able to provide the slides? Will you be able
Sure, I will. I don't know, how should we do it? I will send it to you and you propagate them, or you put it on a web page or wherever?
So if you can just send it to us, and from the viewers, whoever needs the slides, please send us an email and we'll send it to you.
Okay. I don't know. I'm not sure if I can attach them as even as, you know, as an attachment in the chat, if it is.
Oh, that would be great. Yeah.
I will try it. Okay. Enough for tonight? Or at least my night, sorry.
Thank you so much. I think you answered all the questions. Thank you very much. We appreciate it. Thank you, Mr. Ametrano, for your time and support to our club. We truly appreciate it. We wish you the very best in all your future endeavors. We want to thank all of our viewers for their time and interest in this webinar. Have a great evening, ladies and gentlemen, and we'll see you soon.
Thank you very much. Keep up with the good work.
Thank you. I appreciate it.